If you want to make money without putting in a lot of effort and move closer to being financially independent, consider getting into dividend investing. Dividend investing is a simple way to earn money regularly without actively working for it. Many people, including myself, prefer it because it offers a steady and reliable source of income that can grow over time. The idea behind dividend investing is to invest in specific stocks that regularly pay out a portion of their profits to shareholders. These payouts are called dividends, and they can provide a consistent stream of income. My ultimate goal with my dividend portfolio is to rely on these dividend payments as a primary source of living expenses. In this video, I will share with you 6 dividend stocks that I believe are crucial for the long term. The focus here is on building wealth over time, so it's important to understand that the stocks I recommend may not have the highest immediate returns. They are chosen for their potential to provide a reliable income stream in the future rather than promising quick riches. So let's take a closer look at these aspects and explore some stocks that meet these criteria. The first company I would like to talk about is Starbucks. I believe it deserves a spot on our list because it has a robust and lasting competitive edge. Starbucks has successfully established a powerful brand that enjoys global recognition and strong customer loyalty. According to a recent report from Starbucks, in 2022, their global comparable store sales increased by 8%. This growth was fueled by a 5% raise in the average purchase amount and a 2% increase in the number of comparable transactions. Notably, Starbucks achieved record-breaking global revenue, with the US setting new highs for an average ticket sales. Despite challenges related to COVID-19, the China market, with 6,000 stores, also performed exceptionally well, achieving record customer satisfaction scores. Additionally, Starbucks has an impressive base of more than 58 million Starbucks Rewards members worldwide. In the United States alone, about 1 in 10 adults is a Starbucks Rewards member. These factors indicate the company's strength and widespread appeal, making it a promising candidate for long-term investing and reliable dividends. The next stock on our list is Johnson Johnson, currently priced at $158 per share. This company operates in the healthcare industry and provides a wide range of customer health products, pharmaceuticals, and medical devices. What sets Johnson Johnson apart is its strong brand reputation, diverse product portfolio, and a global distribution network, giving it a competitive edge in the market. If we take a closer look, the company currently offers an initial dividend yield of around 3%. This means that, based on the current stock price, investors can expect a return of 3% in the form of dividends. This, along with Johnson & Johnson's stability and presence in the healthcare sector, makes it a noteworthy candidate for long-term investment, especially for those seeking reliable dividend payments. While Johnson & Johnson may not boast the highest starting dividend yield among the stocks on our list, hovering around 3%, it stands out due to its impressive track record. Johnson & Johnson is recognized as a dividend king, having consistently increased its dividend for 50 consecutive years or more. This remarkable feat highlights the company's dedication to delivering value to shareholders through steady and continual dividend growth. Even though the initial yield may not be the highest, the long-standing history of consistent dividend increases suggests a reliable and gradually growing source of income for investors over the years. This makes Johnson & Johnson an appealing choice for those prioritizing a strong dividend track record in their long-term investing strategy. If you found any value so far, please like and subscribe. Our third stock of interest is Proctor Gamble. This multinational company specializes in consumer goods and operates across multiple segments, including beauty, grooming, healthcare, fabric and home care, as well as baby, feminine, and family care. Procter & Gamble is recognized for its extensive portfolio of well-known brands such as Crest, Tide, Pampers, Gillette, and more. What sets Procter & Gamble apart is its broad economic moat, which is established on the foundation of strong brand recognition, a wide-reaching distribution network, and a commitment to continuous innovation. This combination of factors contributes to the company's resilience and market presence, making it a compelling choice for those seeking stability and growth in the consumer goods sector. Examining Procter & Gamble's financial performance reveals a history of steady growth. Over the years, the company has consistently increased its revenue and net income, Moreover, Procter Gamble has exhibited growth in its net income, showcasing its ability to generate profits over time. Additionally, the company boasts a robust financial position, evidenced by its AAA credit rating, indicating a strong and reliable balance sheet. These positive financial indicators further support Procter & Gamble's appeal as a potential long-term investment for those seeking stability and consistent returns in the consumer goods industry. Our fourth stock to consider is Coca-Cola. As a prominent beverage company, Coca-Cola boasts an extensive portfolio featuring well-known brands like Coca-Cola, Diet Coke, Sprite, Fanta, and others. The company's competitive edge is strengthened by its global reach, effective marketing strategies, and robust distribution capabilities. Coca-Cola's ability to maintain a significant presence in the beverage market, coupled with its strong brand recognition, positions it as a compelling investment option. The company's capacity to appeal to a wide consumer base and its established market dominance make it a noteworthy choice for those seeking stability and growth in the beverage industry. Analyzing Coca-Cola's financials reveals a pattern of stability. The company has maintained consistent revenue levels over the past few years, hovering around $37 billion. This steady financial performance is indicative of Coca-Cola's ability to sustain its market position and generate reliable income. Looking at the details for Coca-Cola in my stock spreadsheet, a few key points stand out. First, the payout ratio is relatively high at 79.3%, indicating that a significant portion of Coca-Cola's earnings goes towards paying dividends to its stockholders. Analysts have set a target price of approximately $62 per share, providing an estimated value for the stock based on expert opinions. Institutional ownership is substantial, with large investment groups holding about 67.7% of Coca-Cola's shares, a sign of confidence in the company. Lastly, Coca-Cola's beta is close to 1 at 0.73, suggesting that the stock's price tends to move steadily and isn't too volatile compared to the overall stock market. These insights help paint a clearer picture of Coca-Cola's financial health, market perception, and attractiveness to investors. Our fifth stock to consider is McDonald's, a worldwide fast food giant recognized for its iconic brand, extensive franchise network, and diverse menu offerings. McDonald's has established a robust economic moat, supported by its strong brand recognition, global reach, and efficient supply chain. The combination of these factors contributes to McDonald's standing as a formidable player in the fast food industry. Its ability to maintain a significant market presence and cater to diverse consumer preferences positions it as a compelling choice for investors seeking stability and growth in the global food service sector. Looking at McDonald's financials, it's clear that the company has been doing well over the years. They have consistently grown their revenue and net income. Back in 2012, their revenue was $27 billion, and by 2021, it had shot up to an impressive $105 billion. This growth shows that McDonald's is thriving in the competitive world of fast food. Not only that, but they have also managed to keep a strong balance sheet, indicating financial stability. Now, let's dive into my stock valuation spreadsheet for McDonald's. The payout ratio is a bit high, sitting at 68.8%. This means that a good chunk of McDonald's earnings goes back to its shareholders in the form of dividends. Looking at what analysts are saying, they believe McDonald's stock should be valued at around $254 per share. This is like an educated guess based on what experts think. Institutional ownership is high, with Big Investments Group owning about 66.3% of McDonald's shares. This is a sign that these large investors have a lot of confidence in McDonald's. Lastly, the beta for McDonald's is close to 1. This means that the price of McDonald's stock doesn't swing around too wildly compared to the overall stock market. So, when you put it all together, these numbers give us a good picture of McDonald's financial health, what experts think it's worth, and how much confidence big investors have in the company. The last company on our list is Love's, identified by its stock sticker LOW, currently priced at $207. Love stands out for its impressive track record of consistently increasing its dividend payouts year after year. Over the past decade, the company has delivered phenomenal returns, with an outstanding growth rate of over 406%. While Love starts with a decent initial dividend yield of around 2.13%, its true strength lies in its remarkable remarkable dividend history. Love's has been on a consistent upward trend, increasing its dividend payments for an impressive 59 consecutive years. This long-standing commitment to rewarding shareholders highlights Love's as a reliable choice for those seeking a combination of capital appreciation and a history of consistent dividend growth. A decade ago, Love's was paying out about 16 cents per share every quarter. Fast forward to today, and that figure has climbed significantly to an impressive $1.10 per share each quarter. This substantial growth in dividend payments is noteworthy. Examining Love's dividend growth rates, we see an outstanding 3-year rate at 24%, a 5-year rate at 20%, and an equally impressive 10-year rate at 20%. In fact, Love's has outpaced most companies in the S&P 500 in terms of dividend growth. Now, turning our attention to the evaluation spreadsheet, Love's currently maintains a comfortably low payout ratio, standing at around 30.6%. This ratio indicates that only about 30.6% of the company's earnings are distributed as dividends. Analysts seem optimistic about Love's future, with a target price of around $230 per share. These numbers further underscore Love's position as a standout in terms of both dividend growth and future investment potential. That's it for today. If after watching this video you decided that you want to start understanding dividend stocks and potentially take action with your own money, I would suggest you to watch video next about 10 buy and hold forever dividend stocks. Thank you for watching, and if you found any value in the video, then don't forget to like, share and subscribe this channel. We will see you in the next video.